What if I told you that the most powerful man in the history of modern finance wasn't a billionaire hedge fund manager, a tech tycoon, or a ruthless corporate raider? What if he was a man who was fired from his first job, ridiculed by the entire establishment, and told that his idea was not only stupid but un-American? Wall Street is built on a single seductive promise that if you are smart enough, fast enough, and aggressive enough, you can beat the market. They sell the dream that you can be the exception to the rule. But in the mid-1970s, one man looked at the data and realized that the entire industry was built on a lie. He realized that for the average investor to win, they didn't need to find a needle in the haystack. They just needed to buy the haystack. This is the story of John Jack Bogle, the founder of Vanguard. It is a story of a man who stood against the odds, against the banks, and against the greed of an entire industry to build a machine that would generate wealth for the common man, not the brokers. Welcome to Capitura. Today, we are not just recounting a biography. We are dissecting a revolution. We are looking at how one man's stubborn refusal to accept the status quo created the passive investing world we live in today. This is the story of how Jack Bogle beat the impossible, and more importantly, it is the blueprint for how you can survive the financial noise of the 21st century. To understand the magnitude of what Bogle did, we have to transport ourselves back to 1975. The investing world was dominated by star stock pickers. The idea was that you paid a professional a high fee, and they used their superior intellect to pick the winners and avoid the losers. Into this arena stepped Jack Bogle with a radically boring idea, an index fund. He launched the first index investment trust, a fund that simply bought the 500 companies in the S&P 500 and did nothing else. It didn't try to beat the market. It just tried to be the market. The reaction was immediate and vicious. The industry laughed at him. They called it Bogle's folly. Competitors circulated posters calling it un-American because, in their eyes, settling for average returns was a sign of weakness. They couldn't understand why anyone would settle for the market average when they could theoretically strive for excellence. But Bogle knew something they didn't want to admit. The excellence they were selling was a statistical illusion. He knew that after fees and trading costs, the vast majority of active managers failed to beat the index over the long term. So, why does this matter today? The voices criticizing passive investing haven't disappeared. They've just changed their medium. Today, you don't see anti-index posters. You see TikTok influencers and YouTube gurus promising you 1,000% returns on the next microcap coin or AI startup. They tell you that diversification is for boomers and that the real money is made by concentrating your bets on moonshots. They are selling the same old lottery tickets that Bogle fought against in 1975, just wrapped in flashier digital packaging. The modern takeaway. In 2024, the pressure to beat the market is amplified by technology. You have apps on your phone that gamify trading, showering you with digital confetti when you buy a volatile stock. The Bogle's folly of today is resisting the urge to participate in the speculative mania of zero DT, 0 days to expiration, options, or chasing the latest AI hype cycle. Bogle's lesson is that boring is not just safe. Boring is mathematically superior. When you see an influencer claiming to have a secret system to beat the market, remember the laughter that greeted the first index fund. And remember who had the last laugh. Bogle's second great insight was about the corrosive nature costs. He famously said, "In investing, you get what you don't pay for." In every other consumer interaction, if you pay more, you generally get a better product. A Ferrari costs more than a Toyota because it is faster. But in finance, the opposite is true. If you pay a fund manager 2% a year to manage your money, you are starting every year in a 2% hole. Over an investing lifetime, that 2% doesn't just reduce your returns. It can consume nearly half of your potential wealth due to the lost power of compounding. He structured Vanguard differently than any other financial company. It was, and remains, a mutual company. It is owned by the funds, which are owned by the investors, meaning owned by you. There are no outside shareholders demanding a profit. This allowed Vanguard to drive costs down relentlessly, forcing the entire industry to follow suit. He called the financial industry the croupier at the casino. The investors put up the money. The investors take the risk. But the croupier takes a cut regardless of the outcome. Bogle wanted to fire the croupier. Let's pivot to the modern landscape. You might think, but trading is free now. Robinhood and others charge zero commissions. This is the great deception of the modern fintech era. While commissions are zero, the croupier has simply gone underground. We now deal with payment for order flow, PFOF, where your trades are sold to high-frequency trading firms. We deal with wide bid-ask spreads and hidden fees in complex crypto products. The costs are no longer explicit line items. They are baked into the execution and the data. The modern takeaway: the tyranny of fees has evolved into the tyranny of hidden costs. Today's investor must be vigilant not just about expense ratios, but about the structure of the products they buy. Look at the thematic ETFs that have exploded in popularity, funds tracking the metaverse or genomics. Many of these carry high expense ratios of 0.75% or more, reminiscent of the bad old days of mutual funds. Bogle's wisdom demands that we look past the marketing label of an investment and scrutinize the cost. Every basis point you pay to a fund manager or a platform is a basis point that isn't compounding for your freedom. Perhaps the most difficult part of Bogle's philosophy is the psychological challenge. He preached a doctrine of stay the course. He advised investors to don't do something, just stand there. In the face of market crashes, wars, and recessions, Bogle argued that the investor's worst enemy was their own face in the mirror. He understood that human beings are hardwired to flee pain, sell when the market drops, and chase pleasure, buy when the market peaks. The index fund was designed to remove the human element from the decision-making process. This philosophy of stoicism helped his followers navigate Black Monday in 1987, the dot-com bust in 2000, and the great financial crisis of 2008. While others were panic selling at the bottom, the Bogle heads, as his followers came to be known, kept automatically buying, securing their financial futures. Bogle knew that time is your friend, but impulse is your enemy. How does this apply to the chaos of the 2020s? We live in an era of algorithmic chaos. The market is no longer just humans shouting in a pit. It is dominated by AI-driven high-frequency trading bots that react to news headlines in microseconds. The volatility is faster and more violent than anything Bogle saw in the 1970s. Furthermore, we carry a 24/7 financial news cycle in our pockets, constantly screaming that the crash is coming or the bull run is here. The modern takeaway: your stay-the-course discipline is under assault by the attention economy. The algorithms of social media platforms are designed to trigger high arousal emotions, fear and greed, because that is what keeps you scrolling and clicking. When you see a doom scroll thread on X, formerly Twitter, predicting collapse of the dollar, or a euphoric Reddit post about a meme stock go to moon, realize that this is simply noise designed to break your discipline. In a world of AI trading and information overload, the single greatest edge you have is the ability to disconnect, ignore the noise, and let compound interest do the heavy lifting. John Bogle passed away in 2019, but his legacy is arguably the most important in the history of personal finance. He didn't become a multi-billionaire like the hedge fund managers he criticized. Instead, he chose to structure his company so that millions of ordinary people could become millionaires. He famously told a story about being at a party with a hedge fund manager who made more money in an hour than Bogle made in a year. When asked if he was jealous, Bogle replied, "No, because I have something he will never have. Enough?" Bogle beat the odds not by playing the game better than Wall Street, but by changing the rules entirely. He proved that the impossible, beating professionals by simply doing nothing, was actually the only rational path. His life is a testament to the power of simplicity, integrity, and the relentless mathematics of long-term compounding. Here is your next step. Take a hard look at your own portfolio today. Are you investing or are you gambling? Are you buying a haystack or are you paying high fees to find a needle? The Capitura way is the path of wisdom, not speculation. If you want to continue this journey of mastering your money and your mind, subscribe to Capitura and turn on notifications. We are building a fortress of knowledge, one book at a time. Thank you for listening, and remember, in a world of odds, be the house. We have spoken about Bogle's triumph, but to truly understand a man, we must examine his greatest failure. Before Vanguard, before the index fund, there was the Wellington Management Company. In the mid-1960s, Jack Bogle was a rising star, but he felt the pressure of a changing world. The 1960s were known as the go-go era on Wall Street. It was a time remarkably similar to the tech bubble of the late 90s or the SPAC craze of 2021. Conservative investing was out. High-speed, high-risk growth stocks were in. The Nifty 50 were the darlings of the market, and fund managers who played it safe were seen as dinosaurs. Bogle, fearing his conservative balanced fund was becoming irrelevant, made a fatal mistake. He merged his company with a high-flying, aggressive growth firm from Boston. He brought in with his kid managers who promised to shoot the lights out. For a brief moment, it worked. Stock prices soared, and the new managers were hailed as geniuses. Bogle later admitted he was intoxicated by the action. He had abandoned his core philosophy of prudence to chase the siren song of performance. Then the music stopped. The bear market of 1973 to 1974 arrived with devastating force. The go-go stocks didn't just fall, they evaporated. The fund's assets collapsed from over $2 billion to under $500 million. It was a catastrophe. The very partners Bogle had brought in turned on him, firing him from the presidency of the company he had spent his life building. He was humiliated, defeated, and publicly shamed. So, why does this ancient corporate drama matter to you today? Because the go-go era never truly ended. It just changes its clothes. Every bull market breeds a new generation of whiz kids who claim that this time is different. They claim that valuation metrics like price-to-earnings ratios don't matter anymore because we are in a new paradigm of technology. In the 60s, it was electronics. In the 90s, the internet. Today, it is artificial intelligence and Web3. The modern takeaway. Consider the rise and fall of Cathie Wood's ARK Innovation ETF during the pandemic. In 2020, her aggressive bets on disruptive innovation and profitable tech companies made her the star of Wall Street. Money poured in, and she was hailed as the modern oracle. But just like the managers Bogle hired in the 60s, when the liquidity cycle turned, the fund crashed, wiping out billions in shareholder value. Bogle's failure teaches us a brutal lesson. Do not confuse a bull market with brains. When you see a fund manager or a YouTuber posting 200% returns in a single year, run the other way. They are likely taking risks that will eventually blow up. The boring path is the only one that survives the winter. Out of the ashes of that failure, Bogle developed a deep respect for a concept he called reversion to the mean, RTM. He often described it as the law of gravity in the financial markets. The concept is simple but devastating to the ego. Over the long term, corporate returns and investment performance tend to gravitate toward the average. If a company grows at 20% a year for 5 years, it is statistically almost certain to slow down in the next 5. If a fund manager beats the market for 3 years, they are statistically likely to underperform in the next 3. Bogle visualized the market as 2 distinct lines. The first line is the investment return, which is the real result of dividends and earnings growth generated by actual businesses. This line moves up slowly and steadily. The second line is the speculative return, which is driven by how much investors are willing to pay for those earnings, the P ratio. This line swings wildly up and down based on hope and fear. Bogle taught that while the speculative line can deviate from the investment line for years, they must eventually meet. Gravity always wins. Let's apply this gravity to the modern market. We are currently living through a period of historic concentration. A handful of companies, the Magnificent Seven, Apple, Microsoft, Nvidia, Google, Amazon, Meta, Tesla, make up a staggering percentage of the S&P 500. Their valuations are sky high, driven by the belief that their dominance is permanent. They are the Nifty 50 of our time. The modern takeaway, a Bogle-style analysis of Nvidia today doesn't question whether it's a great company. It clearly is. It questions whether any company can defy gravity forever. Bogle would look at the trillions of dollars in market cap and ask, can they really grow earnings fast? Enough to justify this price for the next decade? History suggests no. The winners of one decade are rarely the winners of the next. In the 1980s, the top companies were oil firms. In the 90s, Japanese banks. In the 2000s, it was GE and Exxon. All of them eventually reverted to the mean. The index investor doesn't need to predict when NVIDIA will slow down. They simply own the whole index, so that when the leadership inevitably rotates to a new sector, they automatically own the new winners too. You don't need a crystal ball. You just need to trust in gravity. There's a fascinating irony in Jack Bogle's legacy. He is the father of index investing, yet he spent the last years of his life deeply critical of the most popular indexing tool, the exchange-traded fund, ETF. To Bogle, the traditional index mutual fund was a long-term marriage. You bought it and you held it. You could only trade once a day, at the closing price. This structure discouraged panic selling and encouraged patience. Then came the ETF, like a mutual fund. It holds a basket of stocks. But unlike a mutual fund, it trades instantly second by second, just like a stock. Bogle called this a bastardization of his great idea. He famously said, "Purists like me believe that trading broadly diversified portfolios is a loser's game." He compared the ETF to handing an arsonist a match. Why, he argued, would you take a product designed for a 30-year time frame and trade it on a 30-second time frame? So, why is this distinction critical for you? Because the financial industry has taken the ETF and weaponized it. They realized they couldn't make money on low-cost index funds held for 30 years. So they created ETFs designed to be traded. We now have leveraged ETFs, like TQQQ or SQQQ, that promise 3x the daily return of the market. These are not investment products. They are betting slips. They are designed to degrade in value over time due to a mathematical quirk called volatility decay. The modern takeaway, the gamification of beta. If Bogle were alive to see the 0DT, 0 days to expiration, option volume on a SPY ETF, he would be horrified. Millions of retail traders are using the S&P 500 not as a vehicle for wealth creation, but as a roulette wheel. The Capitura lesson here is about behavioral guardrails. Just because you can sell your entire portfolio in 1 second on your phone while sitting on the toilet doesn't mean you should. The liquidity of ETFs is a bug, not a feature, for the long-term investor. If you use ETFs, which are great for tax efficiency, you must mentally treat them like illiquid mutual funds. Do not check the price at 2 p.m. Do not trade the news. Use the modern tool, but keep the old-school mindset. One of Bogle's deepest intellectual contributions was his warning about corporate governance. In the old days of capitalism, the owner of the business, the capitalist, also ran the business. Think of Henry Ford or John D. Rockefeller. But today, we have managerial capitalism. The people who run the company's CEOs are not the owners. They are hired hands. The actual owners are the shareholders, which means you, through your index funds. Bogle identified a massive conflict of interest called the agency problem. CEOs are incentivized to boost the stock price in the short term to maximize their stock options, often at the expense of the long-term health of the company. They might cut R&D, fire workers to boost margins artificially, or take on dangerous debt to buy back shares. Who is supposed to stop them? The shareholders. But if the shareholders are mostly passive index funds who don't do anything, who is watching the store? Bogle argued that index funds like Vanguard, BlackRock, and State Street have a moral duty to be active voters even if they are passive investors. They must stand up to greedy CEOs and demand better behavior. How does this impact the 2020s landscape? This is the heart of the current war over ESG, environmental, social, and governance investing. Regardless of your political stance on ESG, the core issue is exactly what Bogle predicted. The big three asset managers now own 20% to 30% of almost every major company in America. They have immense power. The modern takeaway: as an investor, you need to understand that your index fund is not just a passive basket of numbers. It is a political block. We are seeing a shift where investors are demanding voting choice, technology that allows you, the individual owner of the ETF shares, to cast your proxy vote rather than letting BlackRock do it for you. This is the next frontier, the ownership society Bogle dreamed of. It reminds us that we are not just consumers of financial products. We are the owners of American capitalism. We have a right to demand that companies are run for our long-term benefit. not for the quarterly bonus of a CEO who will be gone in 3 years. 41:15 Part 8. The Fiduciary Standard, the Doctor versus the Butcher. Throughout his career, Bogle fought a bitter war to establish a fiduciary standard for all financial advisors. The distinction is subtle but profound. A fiduciary is legally required to act in your best interest like a doctor or a lawyer. If a cheaper product exists that is better for you, they must recommend it. On the other side is a suitability standard, which governs most brokers and insurance salespeople. They only have to sell you a product that is suitable. If they have two funds, one that costs you 0.1% and one that costs you 1% but pays them a huge commission, they are allowed to sell you the expensive one. Bogle viewed this as a moral outrage. He asked, "Would you trust a doctor who prescribed you a pill because the pharmaceutical company paid him a kickback?" Why is this battle still raging today? Because the lines are blurred. Free trading apps and robo-advisors often mask their true incentives. When a platform offers you a high-yield savings account or a crypto wallet, are they doing it for you or because they earn a spread on your cash? The modern takeaway: the rise of finfluencers, financial influencers. This is the wild west of non-fiduciary advice. When a YouTuber tells you to buy a specific coin or sign up for a specific trading platform, they are often being paid strictly for the referral. They are the modern brokers, but with zero regulation. Bogle's test is the only shield you have. Cui bono? Who benefits? If you cannot clearly see how the person giving you advice gets paid, you are the product, not the client. Always look for fee only. Fiduciary advisors who charge you directly for their time, rather than taking a hidden cut of your wealth. We move now from the mechanics of money to the soul of money. In his final book, aptly titled enough, Bogle tells a story about the writers Kurt Vonnegut and Joseph Heller. They are at a party hosted by a billionaire hedge fund manager. Vonnegut asks Heller, "How does it feel to know that our host makes more money in a single day than you made from your book catch, 22 in its entire history?" Heller responds, "I have something you will never have. Enough." Bogle saw the financial industry as a machine designed to create dissatisfaction. It tells you that you need more yield, more growth, more alpha, so that you keep trading and paying fees. It turns money from a tool for life into a scoreboard for ego. Bogle argued that the endless pursuit of more destroys value, both in markets and in life. So, how do we find enough in the age of Instagram? We are bombarded with lifestyle porn. We see 20-year-olds in Lamborghinis and day traders flashing Rolexes. The feeling of relative poverty is higher today than ever, even if our standard of living is higher. This leads to lifestyle creep, where as soon as we make more money, we spend it to signal our status, leaving us with zero compounding assets. The modern takeaway: Bogle is the spiritual grandfather of the FIRE movement, financial independence, retire early. The goal of the intelligent investor is not to have the biggest pile of money at the graveyard. The goal is to reach your number, the amount where your passive income covers your needs, and then reclaim your time. Bogle's life was simple. He lived in the same house for decades. He wore simple suits. He didn't want a yacht. He wanted a legacy. In 2024, the most rebellious thing you can do is to define what enough looks like for you, reach it, and then stop playing the game. Jack Bogle launched a revolution with a simple idea, but it was his character that built the empire. He proved that in a sea of sharks, you don't have to be a bigger shark. You can be the lighthouse. He stood against the odds of Wall Street's greed, against the odds of ridicule, and against the odds of his own failing health. He lived with a transplanted heart for 23 years. He gave us the tools: the index fund, the low-cost philosophy, the fiduciary mindset. But tools are useless without the temperament to wield them. The market will always try to seduce you. It will offer you the next AI bubble, the next crypto moonshot, the next sure thing. And when it does, you must hear the voice of Jack Bogle whispering, "Stay the course." We have explored the history, the failures, the mechanics, and the philosophy. But there is one final frontier. How do you actually build this portfolio? What is the specific architecture of a Boglehead portfolio in a world of global instability and inflation? In the next chapter of Capitura, we will open the blueprints. We will look at the three-fund portfolio, the debate over international stocks, and how to handle bonds when interest rates are volatile. You are building a cathedral of wealth, brick by boring brick. Do not let anyone tell you to rush the foundation. If you want to see the blueprints, subscribe and stay tuned. This is Capitura, and the journey continues. We have discussed the philosophy and the history, but now we must lay bricks. How does the intelligent investor actually build a fortress? Jack Bogle did not just leave us with vague aphorisms. He left us with a blueprint so simple that Wall Street has spent 50 years trying to complicate it. This blueprint is known as asset allocation. Bogle argued that 94% of the variability in your returns comes from asset allocation, the mix of stocks and bonds you hold, and only 6% comes from the specific stocks you pick or the timing of your trades. Think about that. The financial industry spends billions of dollars analyzing individual companies, reading charts, and watching Fed meetings, all chasing that 6%. Bogle tells us to ignore that entirely and focus on the 94%. He proposed a portfolio structure that is elegant in its minimalism, in its purest form. It is often called a three-fund portfolio. A total stock market index fund, domestic, a total international stock index, fund a total bond market fund. That's it. There are no sector bets, no AI-focused ETFs, no crypto, no commodities. Why? Because Bogle believed in owning productive assets. Stocks produce earnings and dividends. Bonds produce interest. Gold, art, and crypto produce nothing. They simply sit there hoping someone else pays more for them later. Bogle called this the difference between investing and speculation. So, why does this simplicity feel so uncomfortable today? Because we live in the age of hyper-customization. We are used to customizing our coffee order, our Netflix feed, and our smartphone home screen. The idea of buying a one-size-fits-all product feels primitive to the modern consumer. We are told by fintech apps that we need direct indexing to optimize for taxes or smart beta to capture factor premiums. The modern takeaway, the rise of complexification as a service. Wall Street hates the three-fund portfolio because it is cheap and they can't trademark it. So they invent complexity to justify fees. Today, you will see model portfolios from robo-advisors that slice your money into 12 or 15 different ETFs. Small cap value, emerging markets bond, real estate, etc. This looks sophisticated, but Bogle would argue it is merely diversification. It adds tax headaches and rebalancing costs without necessarily adding expected return. The modern investor must resist the urge to tinker. The boring, simple, three-fund structure is not a starter portfolio. It is the ultimate portfolio. It is the black belt of investing. It signifies that you have transcended the need for complexity. Now we arrive at one of the few areas where Bogle's followers often disagree with the master: international investing. Jack Bogle was a patriot, but his investment preference for the United States was based on data, not just flag-waving. He famously argued that the average American investor did not need to own international stocks. His logic was twofold. First, U.S. companies are already global. When you buy the S&P 500, you are buying Apple, Coca-Cola, and Ford, companies that do business all over the world. You are getting international exposure through the back door. Second, he viewed international markets as carrying extra risks, currency fluctuation, and unstable governments, without guaranteeing extra returns. For decades, Bogle was right. The U.S. market crushed the international markets in the 2010s and early 2020s. But modern Bogleheads, the disciples, argue that the world has changed. The U.S. is now only about 60% of the global equity market. By ignoring the other 40%, you are betting that American exceptionalism will last forever. How do we resolve this in the 2020s? We look at the valuations. Bogle always taught us that valuation matters. Today, the U.S. market trades at a high premium compared to Europe and emerging markets. The Shiller PE ratio of the U.S. is often double that of other regions. The modern takeaway, the concept of regime change. Just because the U.S. tech giants dominated the last 15 years does not mean they will dominate the next 15. In the 1980s, the Japanese stock market was the king of the world, making up nearly 45% of the global market cap. Investors who only bought Japan were wiped out for 3 decades. A truly defensive, Capitura-style portfolio today likely includes international diversification, not because we know foreign stocks will win, but because we are humble enough to admit we don't know who will win. We buy the whole haystack, and that haystack is now global. If stocks are the engine of wealth, bonds are the brakes. And nobody likes paying for brakes until they are careening toward a cliff. Bogle's stance on bonds was rigid. You must own them, regardless of the yield. This was a hard pill to swallow in the 2010s and early 2020s, when interest rates were near zero. Investors coined the acronym TINA, there is no alternative, to justify putting 100% of their money into stocks, arguing that bonds are dead money. Then came 2022. The Fed raised rates at the fastest pace in history. Bonds suffered their worst year in decades. The 60-40 portfolio, 60% stocks, 40% bonds, had one of its worst years ever. The critics screamed that Bogle was finally wrong. That bond provided no safety, only losses. But Bogle would look at 2022 differently. He would see it as a return of sanity. When yields were zero, bonds were risky. Now that yields have normalized to 4% or 5%, bonds are once again doing their job, providing income and a cushion against deflationary recessions. He taught that bonds are not there to make you rich. They are there to keep you from selling your stocks when the market crashes 50%. They are psychological anchors. The modern takeaway, the danger of yield chasing. In a world where safe government bonds pay 4 to 5%, many investors are still tempted by private credit funds or high-yield DeFi, decentralized finance, protocols promising 10 to 15%. Bogle would warn that there is no free lunch. If an asset is paying 12% when the Treasury pays 5%, the difference is not alpha, it is risk. That 12% yield comes with the risk of total loss. The intelligent investor accepts the boring yield of high-quality bonds because they act as dry powder. When the stock market eventually crashes, the bondholder is the only one with stable capital to rebalance, selling their stable bonds to buy cheap stocks. Bogle was obsessed with net return. He didn't care what your portfolio earned. He cared what you kept. He introduced a concept that is rarely discussed on financial TV, the tax-cost ratio. Mutual funds that trade frequently, high turnover, generate capital gains taxes that are passed on to you, the investor, every year. It's like a leaky bucket. You might earn 10%, but after fees, 1%, and taxes on funds trading 2%, you only keep 7%. Index funds are tax efficient by nature. Because they simply hold the index, they rarely sell. They don't generate capital gains until you decide to sell. This allows your money to compound tax-free for decades. Bogle called this the greatest government subsidy available to the common man, yet most investors ignore it, focusing on pre-tax returns. Pivot to the algorithm age. Today, the tax trap is hidden in crypto trading and Robinhood flipping. Every time you sell a coin or a stock for a profit, you trigger a taxable event. The apps don't show you this. They show you your total gain in green. They don't show you the bill from the IRS that is coming in April. The modern takeaway, the power of asset location. In the modern tax environment, where you hold your assets matters as much as what you hold, Bogle's principle suggests placing inefficient assets, like bonds or REITs, which generate taxable income, inside tax-sheltered accounts like IRAs or 401ks, while keeping tax-efficient index funds in your standard brokerage account. This is a level of optimization that requires zero extra risk, just a little bit of planning. It is a free lunch of the tax code. As Bogle neared the end of his life, a new criticism emerged, one that has grown louder in 2024. Critics like Michael Burry of The Big Short fame and Elon Musk have argued that passive investing has become a bubble. Their argument is that if everyone just buys the index, nobody is doing the work of analyzing the companies. This leads to price discovery breaking down. Bad companies get bought just because they're in the index, and good companies get ignored. They argue that index funds have become a communist force in the market, allocating capital blindly. Bogle addressed this before he died. He admitted that if everyone indexed, if 100% of the market was passive, it would be chaos. But he pointed out that we are nowhere near that. Even today, while passive funds own a lot of stock. The trading is still done by active managers. The hedge funds and high-frequency traders set the prices. The index funds just accept them. Why does this matter to your strategy? Because you will hear scary narratives telling you to get out of the index before the bubble bursts. You will hear that stock picking is back. The modern takeaway: this is a narrative trap. Even if indexing is too big, the alternative is still worse. If you try to become an active stock picker to exploit the inefficiencies of indexing, you are stepping back into the ring with the high-frequency algorithms and institutional sharks. Bogle's counter-argument is that as long as there is some active trading, which there always will be, because greed is eternal, index prices will remain reasonably accurate. Do not let the fear of theoretical index bubble scare you out of the only strategy that has worked for 50 years. The irony is that if indexing ever did become too big and inefficient, active managers would start winning again. But the data shows they are still losing. We have built the portfolio. We have balanced the assets. We have minimized the taxes. Now comes the hardest part: living with it. Bogle often said that investing is not a battle of intellect. It is a battle of nerves. The market is designed to make you feel stupid. When your neighbor makes 500% on a meme stock, you feel stupid holding your boring index fund. When the market crashes 30% and the news says capitalism is ending, you feel stupid for not selling. Bogle's solution was benign neglect. He famously advised investors, look at your portfolio once a year. If you look more often, you will see volatility. If you look less often, you will see returns. How do we practice benign neglect in the smartphone era? It is nearly impossible. Our phones push notifications of market moves to our lock screens. We check our net worth while waiting for the elevator. This hyper-awareness creates myopic loss aversion. We feel the pain of a 2% drop today much more than the joy of a 100% gain over 5 years. The modern takeaway: you must build digital firewalls. This is a practical application of Bogle's philosophy in 2024. Delete the app. Do not have your investment brokerage app on your phone. Force yourself to log in via a desktop computer to trade. This adds friction. Friction is a friend of the impulse control challenge. Unfollow the noise. Mute financial news accounts on Twitter/X. Unsubscribe from Daily Market Watch emails. Automate the pain. Set up automatic contributions from your paycheck. If the money leaves your account before you see it, you are dollar cost averaging without emotional input. You are buying more shares when the market is down on sale, and fewer when it is up, automatically executing the buy low strategy that humans fail at. As we conclude this deep dive into Against the Odds, we must look at the man himself one last time. Jack Bogle was a man of contradictions. He was a multimillionaire who wore a $14 watch. He was a Republican who railed against the excesses of capitalism. He was a heart transplant recipient who lived every day with a sense of borrowed time. He called his followers the Bogleheads, and he loved them. He would show up to their conferences not as a CEO, but as a fellow traveler. He would sit in the cafeteria and eat with them. He understood that he hadn't just built a company. He had built a movement of financial liberation. His final message to us was about stewardship. He believed that we are stewards of our wealth, not for the purpose of buying luxury goods, but for the purpose of security, charity, and family. He saw the index fund as the great equalizer, a tool that allowed the janitor to get the exact same return as the CEO. The ultimate modern takeaway. In a world that celebrates the Sigma grind set and the hustle culture, Bogle's life offers a quiet counter-narrative. You don't need to check charts at 4 a.m. You don't need to outsmart the world. You just need to be patient, disciplined, and humble. The greatest wealth is not found in the alpha of your portfolio, but in the alpha of your life. The time you get back by not obsessing over the market. We have traveled from the go-go years of the 1960s to the algorithmic chaos of the 2020s. We have dismantled the myths of stock picking, exposed the tyranny of fees, and laid the blueprint for a fortress of wealth. Against the Odds is not just a biography of Jack Bogle. It is a biography of the resilience of the common investor. You now possess the knowledge that Wall Street tries to hide. You know that cost matters. You know that time matters. You know that behavior matters. The question is, what will you do with this knowledge? Will you go back to chasing the next shiny object? Or will you join the ranks of the intelligent investors who play the long game? The path is boring. The path is slow. But the path is sure. Here is your next step. Open your brokerage account. Look at the expense ratios of the funds you own. If you see anything above 0.5%, ask yourself, is this manager really 5 times better than the market? If the answer is no, and it almost always is, make the switch, simplify, automate, and then go live your life. If you want to continue this education, if you want to arm yourself with the wisdom of the greatest financial minds in history, subscribe to Capitura. We are not here to sell you a course. We are here to translate the truth. The next book we cover will challenge everything you think you know about risk. You won't want to miss it. To continue our deep dive into the philosophy of John Bogle and Against the Odds, we will now expand into the granular mechanics of wealth destruction, fees, and the societal shift in retirement that Bogle predicted. We have spent much of our journey discussing the efficient market hypothesis, the idea that it is hard to beat the market because prices reflect all available information. But Jack Bogle had a different, more practical theory. He called it the cost matters hypothesis, CMH. This was not an academic theory born in an ivory tower. It was a mathematical fact born in the trenches of the mutual fund industry. The hypothesis states, simply, gross return minus cost equals net return. The market return is the gross return. That is what the businesses actually earn. But investors do not earn the market return. They earn the market return minus the cost of financial intermediation. Therefore, as a group, investors must underperform a market by the exact amount of fees they pay. Bogle realized that the financial system is the only industry where providers, brokers, managers take a massive slice of the pie before the customers, investors, even get a fork. He used a stunning analogy to explain this. Imagine a family of investors who own 100% of the U.S. stock market. If they just sit there and hold the stocks, they reap 100% of the dividends and earnings growth. But now, introduce a group of helpers, brokers, consultants, and fund managers. The helpers convince the family that they can improve their results by trading stocks with each other. The family starts paying the helpers fees to swap stocks. At the end of the year, the gross return of the market is the same, but the family's share has shrunk by the amount paid to the helpers. The helpers have added zero value in aggregate, but have extracted massive cost. So, why is this helper dynamic even more dangerous in 2024? Because the helpers have become invisible. In Bogle's day, you wrote a check for a commission. Today, the costs are hidden in the plumbing of the financial system. We see this in the spread on crypto exchanges. When you buy Bitcoin on a convenient app, you might pay a price $500 higher than the actual market price. That spread is a helper taking his cut. We see it in gas fees on the Ethereum network. You want to move your assets? You must pay the miners. The modern takeaway, the rise of frictionless extraction. The modern financial app is designed to make the act of paying fees feel painless or even non-existent. When you trade on a zero-commission platform, you're often getting a worse trade execution price. Bogle CMH teaches us to be forensic accountants of our own lives. You must calculate the total cost of ownership of your portfolio. If you're paying 1% to an advisor, 0.5% in fund fees, and losing 0.2% to trading spreads, you're giving away nearly 30% to 40% of your long-term potential wealth. The intelligent investor minimizes the helpers to maximize their own share of the harvest. Bogle often used a specific metric to terrify investors into compliance: the effect of fees over a lifetime. He called this the tyranny of compounding costs. We all know that compound interest is a miracle that turns a little money into a lot. But compound costs are the reverse, a disaster that turned a lot of money into a little. Let's look at the math Bogle presented. Assume the stock market returns 7% per year over 50 years. If you invest $10,000 and pay zero fees, that money grows to roughly $300,000. That is the miracle of compounding. But now, assume you pay a modest fee of 2% per year to a fund manager. That 7% return becomes a 5% return. Over 50 years, your $10,000 grows to only about $110,000. Pause and let that sink in. You put up 100% of the capital. You took 100% of the risk. But the financial manager, who put up zero capital and took zero risk, took nearly 65% of your final return. Bogle asked the ultimate question, is this fair? He argued that the financial industry is essentially a vampire squid, extracting the majority of the market's long-term rewards from the people who actually take the risks. How does this apply to the fintech generation? Many modern investment platforms charge subscription fees or management fees that sound small, perhaps $10 a month or 0.25% a year. But we must look at the crypto staking schemes and yield farming protocols that were popular in 2021. They often promise high returns but charge massive exit fees or performance fees of 20%. The modern takeaway: you need to calculate your T-Rex score. This is a modern concept inspired by Bogle. It stands for Total Return Efficiency Index. It asks, what percentage of the market's return will I actually keep? If you buy a Vanguard ETF with an expense ratio of 0.03%, your T-Rex score is 99.97%. You keep almost everything. If you buy a hedge fund with a 2 and 20 fee structure, your T-Rex score might be less than 40%. In a low-return world, you cannot afford to feed the T-Rex. Every dollar you pay in fees is a soldier you are removing from your army of compound interest. Bogle's legacy is a realization that cost is the only variable you can control. You cannot control the market return, but you can control the fee. One of the most critical chapters in Bogle's intellectual life was his critique of the American retirement system. He witnessed a great shift from defined benefit pension plans to defined contribution 401k plans. In the old days, a company managed the money. They had professional treasurers who invested the pension fund for the long term. If the market crashed, the company was on the hook to pay your pension. The risk was on the employer. Then came the 401k revolution. The risk was shifted entirely to the employee, to you. Suddenly, a school teacher or a factory worker was expected to become their own chief investment officer. They had to decide how much to save, what funds to buy, and when to sell. Bogle argued that this was a disaster in the making. He pointed out that the average person has neither the time, the interest, nor the expertise to manage a complex investment portfolio. The result, he predicted, would be lower returns, higher fees, and a retirement crisis. He was right. Studies show that 401k participants often buy high at the top of the market and sell low at the bottom. They borrow against their 401k to buy cars. They fail to save enough. The great experiment of making everyone a capitalist has, in many ways, failed the average worker. So, what is the solution in the 2020s? The system hasn't gone back to pensions. In fact, it had become even more fragmented with the gig economy. Uber drivers and freelancers have no 401k at all. They are entirely on their own. The modern takeaway: the rise of the target date fund, TDF. Bogle considered the target date fund to be one of the few good innovations in modern finance. A TDF is a set-it-and-forget-it fund. You pick the year you retire, e.g., the Vanguard Target Retirement 2055 fund, and the fund automatically manages the asset allocation for you. It starts aggressive with stocks when you are young and slowly glides into bonds as you get older. For the modern investor who is overwhelmed by choice, Bogle's advice is to embrace this automation. The TDF is the closest thing we have to a personal pension. It removes the temptation to tinker. It prevents you from being too aggressive at 60 or too conservative at 25. If you do not want to be a Boglehead hobbyist managing a 3-fund portfolio, the TDF is the single best default option. It is the autopilot that lands a plane safely. We touched on this earlier, but Bogle's crusade wasn't just about money. It was about morality. He believed that handling other people's money is a sacred trust. He was deeply religious in his own way, often quoting the Bible and moral philosophy. He viewed the financial industry not as a business, but as a profession, like medicine or law, that had lost its way by becoming a marketing machine. He railed against the marketing of mutual funds. He hated the advertisements that showed people on sailboats or walking on beaches. He argued that funds should be sold based on characteristics, cost, risk, diversification, not promises of a lifestyle. He famously said, The mutual fund industry is a marketing business that happens to do some investing. How does this moral lens apply to the influencers of the day? We live in the age of the parasocial financial relationship. People form emotional bonds with YouTubers, TikTok stars, or tech CEOs like Elon Musk. They invest based on who is talking, not what the numbers say. When a celebrity endorses a crypto exchange like FTX, they are transferring their trust to a financial product. The modern takeaway: the need for skeptical stewardship. Bogle teaches us that in finance, charisma is a red flag. If an investment needs a Super Bowl commercial, it is probably overpriced. If a CEO is spending all their time tweeting, they are probably not focusing on operations. The intelligent investor looks for the quiet stewards. They look for the boring, unsexy companies that simply compound capital year after year without fanfare. They look for the advisors who act as fiduciaries, putting the client's interest first, even if it means earning less money. In a world of hype men, be a steward. Let's return to the most persistent criticism of Bogle's legacy, the idea that passive investing breaks the market. We discussed this briefly, but we need to go deeper. The argument is that if nobody is doing the research, capital is misallocated. Zombie companies stay alive because index funds have to buy them. Bogle's counterargument was nuanced. He believed that active management is necessary for price discovery, but that we currently have too much of it. He estimated that perhaps 10% or 20% of the market needs to be active to set efficient prices. The other 80% or 90% can safely free ride on those prices via indexing. We are still far from the danger zone, but he also warned of a different danger: corporate concentration. If Vanguard, BlackRock, and State Street own 20% of every airline, do they have an incentive to let those airlines compete aggressively? Or do they prefer an oligopoly where prices stay high in profits and stock prices remain stable? This is known as the common ownership problem. Why does this matter to you? Because it suggests that the golden age of indexing might face regulatory headwinds. Governments are starting to look at the power of the big three index providers. The modern takeaway: diversification beyond the S&P 500. While the S&P 500 is a core, Bogle's philosophy of owning the market protects you from regulatory changes too. If the U.S. government breaks up big tech or regulates index funds, the investor who owns small caps via a total market fund and international stocks is insulated. The Capitura strategy is to own the entire haystack, not just the top 500 needles. This protects you against the specific political risk of the S&P 500 becoming too big to fail, and thus a target for politicians. To truly understand the power of Bogle's stay-the-course philosophy, we must look at the periods where it didn't seem to work. The most brutal test for Bogleheads was the lost decade from 2000 to 2009. Imagine you started investing in 1999. You bought the S&P 500 index fund. Then the dot-com bubble burst. The market crashed 50%. You held on. Then the market recovered until 2007. Then the great financial crisis hit. The market crashed 50% again. By early 2009, after 10 full years, your annualized return was negative. You had made less money than if you had stuffed cash under your mattress. Critics screamed, "Buy and hold is dead." They argued that you have to be nimble, you have to trade, you have to use leverage. Bogle stood firm. He argued that 10 years is a blink of an eye in market history. He pointed to the dividends that were reinvested during those lows. He urged investors not to capitulate. The result: those who sold in 2009 missed the greatest bull market in history, 2010 to 2021. Those who stayed the course, reinvesting dividends at the market lows of 2009, saw their portfolios explode in value over the next decade. The lost decade was actually the accumulation decade for the smart investor. It was a period where they bought cheap shares that fueled their future wealth. The modern takeaway: the recency bias of the 2020s. Many young investors have only seen a market that goes up mostly. When the next lost decade comes, and you will need this case study burned into your brain. You will see years where your index fund does nothing. You will see years where it goes down. The influencers will mock you. They will say indexing is broken, but you will remember 2000 to 2010. You will remember that the spring is being coiled. You will keep buying. And when the cycle turns, you'll be the one holding the assets that appreciate. Jack Bogle was an innovator, yet he hated innovation in financial products. This seems contradictory. How can an innovator hate innovation? Bogle distinguished between functional innovation, which makes things better, cheaper, or faster, and marketing innovation, which makes things more complex to sell them for a higher price. The index fund was functional innovation. It lowered costs and improved results. But Bogle viewed almost everything else, options, leveraged ETFs, SPACs, crypto, junk bonds, as marketing innovation. He famously said, "In 250 years of financial markets, I have not seen a single innovation that has benefited the investor other than the index fund." How do we apply this skepticism to AI? We are currently being told that AI will revolutionize investing. We are told that robo-traders will pick stocks better than humans. Bogle would be deeply skeptical. He would argue that if AI does work, it will be used by the giant hedge funds to compete with each other, effectively canceling out the advantage. The market will just become more efficient, making it even harder to beat. The modern takeaway: AI is a tool for efficiency, not for alpha. Use AI to organize your finances. Use AI to tax loss harvest. Use AI to analyze your spending. But do not believe the sales pitch that an AI bot can predict the stock market for you. If an AI could truly predict the market, its creator would not sell it to you for $99 a month. They would use it to become the richest person on earth in silence. The fact that they are selling it proves it doesn't work. Stick to the Bogle functional innovation, low cost, broad diversification. We close our analysis with the most important asset class of all, character. Jack Bogle's career was derailed in his 40s. He was fired. He was mocked. He had a bad heart. He could have easily become bitter. He could have become a cynic. Instead, he built Vanguard. He proved that integrity is a scalable strategy. In a world where Wall Street was focused on quarterly earnings, Bogle focused on lifetime trust. Vanguard didn't spend money on advertising. They spent money on lowering fees. And slowly, year by year, the trust compounded. Today, Vanguard manages over $7 trillion. The tortoise beat every single hair. The modern takeaway: your investing strategy is a reflection of your character. Are you patient? Are you humble? Can you delay gratification? The market is a mirror. If you are greedy and impatient, the market will destroy you. If you are disciplined and stoic, the market will serve you. Bogle's life asks us, what are you building? Are you building a portfolio of lottery tickets, hoping to get lucky? Or are you building a cathedral of stone designed to last for generations? The Capitura community chooses a cathedral. We choose the hard work of patience. We choose the wisdom of enough. And we choose to stand against the odds. We have now covered the complete arc of Against the Odds. We have dissected the mechanics of the index fund, the psychology of the investor, and the morality of the market. You have the blueprint. The rest is up to you. Remember, the greatest enemy you face is not the Federal Reserve, not inflation, and not the bear market. The greatest enemy is the face looking back at you in the mirror. Master yourself, and you master the market. If this deep dive has shifted your perspective, if it has given you the courage to be boring in an exciting world, then our job here is done. But the library of wisdom is vast. Our next journey will take us into the mind of a man who broke the Bank of England. We will explore the concept of reflexivity and how perception shapes reality. Make sure you are subscribed to Capitura. The class is just beginning. We often talk about stock prices. We watch the ticker tape flash green and red. But Jack Bogle taught that the price is merely the shadow. The dividend is the substance. In his analysis of market history, Bogle broke down stock returns into two components: investment return, earnings growth plus dividend yield, and speculative return, change in P ratio. He found something that shocked the go-go investors. Over the very long-term decades, speculative return is zero. The P/E ratio eventually reverts to the mean. The entirety of the market's return comes from the investment return, and a massive portion of that comes from reinvested dividends. Bogle called dividends the silent engine of the market. They are not exciting. They do not double overnight, but they are relentless. If you look at the S&P 500 from 1926 to today, the price appreciation alone would have turned $1 into a respectable sum. But if you include reinvested dividends, that $1 turns into a fortune that is exponentially larger. The dividend is a compounding accelerator. So why have we forgotten this in the 2020s? Because modern tech companies, Tesla, Amazon, Google, largely do not pay dividends. They retain their earnings for growth. This has trained a generation of investors to look only at price appreciation. We have become capital gains junkies. We only care if the line goes up. The modern takeaway, the danger of phantom wealth. When you rely solely on price appreciation, you are relying on the mood of the market to pay you. You have to sell the stock to eat. But when you build a portfolio of dividend-producing index funds, you are being paid by the business, not the market. In a flat market, which we could easily face in the next decade, the capital gains junkies will starve, but the dividend investor will keep compounding. The Capitura strategy suggests that as you mature, you should appreciate the boring checks that show up in your account every quarter, regardless of what the news says. Jack Bogle was born in 1929. He lived through the Great Depression, but he also lived through the great inflation of the 1970s. He knew that money is like an ice cube sitting on a sidewalk in July. It is constantly melting. He viewed inflation as the investor's invisible adversary. Bogle argued that keeping your money in cash, under the mattress or in a checking account, is not safe. It is actually a guaranteed loss. If inflation is 3%, your cash loses half its value in 24 years. Therefore, you must invest in assets that can outrun the melting ice. Stocks are the first line of defense because companies can raise prices. But Bogle also loved a specific, often ignored asset class. TIPS, Treasury Inflation-Protected Securities. How do we apply this defense today? We are living in a post-2020 world where inflation has reawakened. The cost of living is soaring. The safe 0.01% savings account is a wealth incinerator. The modern takeaway, the distinction between nominal and real returns. This is a Boglehead mental model you must adopt. If your crypto portfolio goes up 10% nominal, but inflation is 8% and taxes take 2%, your real return is zero. You ran fast just to stay in the same place. Bogle's advice for the modern era is to look at I bonds, Series I savings bonds, and TIPS as a slice of your bond allocation. These are the only assets on earth guaranteed by the U.S. government to keep up with the cost of living. They are the shield against the thief in the night. The philosopher Isaiah Berlin famously divided thinkers into two categories, foxes and hedgehogs. Foxes know many small things. Hedgehogs know one big thing. Wall Street is full of foxes. They know about currency arbitrage, data decay, candlestick patterns, and geopolitical pivots. Jack Bogle was the ultimate hedgehog. His one big thing was this: the gross return of the market minus the cost of the market equals the net return of the investor. That's it. That one sentence destroyed entire libraries of financial theory. The foxes tried to complicate it. They built complex models to prove they could beat the market. But Bogle simply repeated his hedgehog truth. Every time a fox invented a new strategy, like long-short equity or smart beta, Bogle would run the math and show that after fees, it failed. Why is it hard to be a hedgehog today? Because complexity signals intelligence to our monkey brains. We think that if a strategy is complicated, it must be better. We think a DeFi-yield farming strategy on Layer 2 scaling solutions must be superior to buying the S&P 500. The modern takeaway, the power of via negativa, addition by subtraction. To improve your financial life, do not add more strategies. Subtract them. Stop trading options. Stop trying to time the federal stop watching CNBC. Stop reading 10K reports for companies you don't understand. When you strip away the complexity, you are left with the Bogle truth. The intelligent investor is a hedgehog who knows that cost and behavior are the only variables that matter. One of the hardest things for successful people to accept about Bogle philosophy is that hard work doesn't pay off. In every other field, medicine, sports, engineering, if you practice more, study harder, and have better equipment, you win. Tiger Woods beats the amateur golfer 100% of the time. But in investing, the opposite happens. This is called the paradox of skill. As Michael Mauboussin, a strategist who expanded on Bogle's work, explains, when everyone is skilled, luck becomes a deciding factor. In the 1960s, it was easy to beat the market because the market was mostly amateur dentists and doctors trading stocks over phone. A professional with a computer had a huge edge. But today, the market is dominated by PhDs, mathematicians, and supercomputers. The average investor is a genius algorithm. Therefore, the skill gap has closed. It is nearly impossible to find an edge because the other guy is just as smart as you. How does this apply to your ego? You might be the smartest person in your office. You might be a brilliant coder or surgeon. But when you enter the stock market, you are playing against a house. The modern takeaway: alpha decay. Any strategy that works gets discovered and exploited until it stops working. If you find a pattern, e.g., buy stocks on Tuesdays, the algorithms will find it too, and the edge will vanish. Bogle's index fund is the only strategy that is immune to the paradox of skill because it doesn't try to win the game of skill. It simply owns the playing field. It admits that the competition is too tough to beat, so it decides to join them by owning the aggregate result of their wisdom market price. We must pause to appreciate the sheer economic impact of Jack Bogle. Economists talk about the Vanguard effect. When Vanguard enters a new market or sector, fees across the entire industry drop. Fidelity, Schwab, and BlackRock were forced to lower their fees not because they wanted to, but because Bogle forced them to. He transferred trillions of dollars from the pockets of Wall Street banks into the pockets of retirees. This is arguably the largest philanthropic transfer of wealth in history, yet it wasn't done through charity. It was done through competition. Why does this matter to the Capitura community? Because it teaches us about incentive structures. Vanguard is the only investment firm that is mutual, owned by its clients. Every other firm has external shareholders they need to please. The modern takeaway: the conflict of interest radar. Whenever you engage with a financial product, ask, who are the shareholders? If you use a free trading app, the shareholders are venture capitalists who need growth. Therefore, the app is designed to make you trade more gamification. If you use a high-fee bank, the shareholders want profit. Therefore, the bank sells you expensive products. Bogle taught us that structure is destiny. You cannot expect a company to act against the interests of its owners. Align yourself with platforms where you are the owner, or at least where the incentives are transparent. Jack Bogle famously said, "The stock market is a giant distraction to the business of investing." He used the analogy of a rowboat. When you row a boat, you move forward, but you are facing backward. You can see where you have been in the past, but you cannot see where you're going in the future. The financial industry sells the idea that they can turn the rower around. They claim they can see the waterfall ahead. They claim they can predict the recession, the pivot, or the boom. Bogle argued that nobody can turn around. We are all rowing backward. We only have the past data, historical returns, past earnings. The future is an opaque fog. So, how do we navigate the fog? We don't try to steer based on predictions. We build a boat that cannot sink. The modern takeaway: all-weather resilience. Since we cannot predict the next black swan event like COVID-19 or the 2008 crisis, we must assume it will happen. We just don't know when. We build a portfolio that can survive anything. This means holding bonds, even when they're boring, for deflation protection. This means holding stocks for growth, inflation protection. This means having cash reserves for emergencies. The Capitura investor stops asking, what will the market do next year? And starts asking, can my portfolio survive whatever the market does next year? In the last decade, we saw the rise of a dangerous obsession, yield farming. In a world of low interest rates, investors became desperate for income. They piled into junk bonds, debt from risky companies, and defied protocols, offering 20% APY. Bogle hated this. He warned that more risk does not guarantee more return. It only guarantees more volatility and the possibility of total loss. There is a fundamental law in economics. Risk and return are correlated. If an asset is paying you 10% when the risk-free rate is 4%, the market is screaming at you that there is a massive hidden risk. The modern takeaway: the collapse of Terra/Luna and Celsius. In 2022, billions of dollars evaporated because investors chased safe 20% yields. They ignored Bogle's law. They thought they had found a glitch in the matrix. Bogle would tell you today, if it yields too much, it's not an investment, it's a trap. Stick to the natural yield of the market dividends and the natural yield of high-quality bonds. Anything else is playing with fire. As we near the end of this deeper exploration, we touch on a sensitive topic: inheritance. Jack Bogle died a wealthy man, but not a billionaire. He gave away half his salary to charity for decades. He was deeply skeptical of dynastic wealth, the idea of leaving so much money to your children that they never have to work. He quoted Warren Buffett, saying you should leave your children enough money so that they would feel they could do anything, but not so much that they could do nothing. He believed that the struggle to build something is what gives life meaning. Robbing your children of that struggle is a disservice. The modern takeaway: the stewardship of values. We are about to see the great wealth transfer as boomers pass trillions to millennials and Gen Z. The Bogle approach to this is not just about tax minimization, trusts, and estates. It is about education. If you build a Bogle-led portfolio that compounds to $5 million, but you don't teach your heirs a philosophy of enough and simplicity, that money will be gone in one generation. The portfolio is the hardware. The philosophy is the software. You must pass down both. Let us synthesize everything into a final code. The Bogle-led philosophy, filtered through the modern lens of Captura, rests on 5 noble truths. The truth of uncertainty. You cannot predict the future. Anyone who claims they can is a salesperson. The truth of cost. You get what you don't pay for. Costs compound against you. Minimize them ruthlessly. The truth of simplicity. Complexity is a product sold to you to extract fees. A simple portfolio outperforms a complex one over time. The truth of time. Time is your greatest asset. Compounding requires uninterrupted patience. The urge to do something is your enemy. The truth of enough. The goal is not infinite wealth. The goal is financial independence and the freedom to live a meaningful life. Jack Bogle was called Saint Jack by his followers, not because he was perfect, but because he was a lighthouse. A lighthouse does not move. It does not chase the ships. It simply stands on a rock and shines the light, warning sailors of dangers. In the stormy seas of the 21st century, with AI trading, crypto volatility, and inflation scares, you need a lighthouse. You need a reference point that does not change. That reference point is the index fund. It is the rock. If you anchor yourself to that rock, you can ignore the storms. You can sleep at night. You can watch your children grow up instead of watching CNBC. And in the end, you will win. Not because you were faster, but because you were steadfast. Now, we must discuss maintenance, defense, and the end game. How do you actually manage this machine over 40 years? How do you handle the specific temptations of real estate and gold? And how do you eventually spend the money without running out? We have established that the Captura portfolio is a mix of stocks, the engine, and bonds, the brakes. But over time, the engine runs faster than the brakes. If you start with a 60-40 portfolio, 60% stocks, 40% bonds, and have a great bull market, your stocks might grow to become 80% of your portfolio. Suddenly, you are taking far more risk than you intended. If the market crashes now, you fall harder. Jack Bogle taught the discipline of rebalancing. This is a mechanical act of selling the asset that has done well, stocks, and buy the asset that has done poorly, bonds, to get back to your 60-40 target. This sounds easy on paper, but it is psychologically excruciating. It requires you to sell your winners right when they feel unstoppable, and buy the losers right when they feel broken. When the stock market is crashing and everyone is screaming sell, the Boglehead rebalancing rule forces you to buy. When the market is in a euphoria bubble, it forces you to sell. Bogle called this contrarianism by automation. It forces you to buy low and sell high without having to make a prediction. It removes the emotion. So, how do we automate this in the 2020s? In the old days, you had to calculate this on a spreadsheet and call a broker. Today, technology has solved the friction. The modern takeaway: the rise of smart rebalancing and robo-advisors. Platforms like Betterment or M1 Finance use dynamic rebalancing. They don't just rebalance once a year. They rebalance with every deposit. If your stocks are overweight, your new deposit automatically goes entirely into bonds to bring the balance back. This is arguably the greatest fintech feature for the average investor because it makes the painful act of buying unloved assets invisible. You don't feel the pain because you never see the trade. The lesson? If you don't have the stomach to sell your winners manually, use software that does it for you. One of the most common questions Bogle received was, I have a large sum of cash from an inheritance, a bonus, or a property sale. Should I invest it all at once, or drip feed it into the market slowly? This is a battle between lump sum investing and dollar cost averaging DCA. Bogle's answer was rooted in probability. Since the market goes up more often than it goes down, roughly 2 out of every 3 years are positive, the math overwhelmingly favors lump sum. If you have the cash, put it to work immediately. Waiting is statistically likely to cost you money because you will likely end up buying at higher prices later. However, Bogle was also a realist about human emotion. He knew that if you invest $100,000 today and the market drops 10% tomorrow, you will feel like an idiot. You might panic and sell. Therefore, he often suggested DCA, investing over 6 to 12 months. Not because it makes more money, but because it acts as regret minimization. How does this apply to the volatility era? In a world where the NASDAQ can move 5% in a single day, the fear of buying the top is paralyzed. The modern takeaway, the regret hedge. If you are sitting on cash today, paralyzed by the fear of a recession, Bogle would tell you to compromise. Put 50% in immediately to capture the potential upside, and DCA the other 50% over the next 6 months to protect against the downside. This is not about optimizing for math. It is about optimizing for sleep. The best strategy is the one you can stick with. If going all in makes you anxious, don't do it. The cost of anxiety is higher than the cost of slightly lower returns. Where did Jack Bogle stand on the American obsession with real estate? Was your home an investment? Bogle was notoriously skeptical of housing as a wealth-building vehicle compared to stocks. He argued that a home is primarily consumption, not investment. You have to live somewhere. A home has massive carrying costs. Property taxes, maintenance, the new roof, the broken boiler, insurance and transaction fees, 6% to realtors. When you factor in all those costs, Bogle pointed out that residential real estate barely outpaces inflation over the very long term, 100-plus years. Stocks, by contrast, are productive assets that pay you to own them. A house takes money out of your pocket. A stock puts money into your pocket. He didn't hate home ownership. He owned a home, but he viewed it as a forced savings account and a place to raise a family, not a way to get rich. Why is this controversial in 2024? Because we have just lived through a decade where housing prices skyrocketed. We see real estate influencers on TikTok telling us to buy rental properties for passive income. We see the Airbnb gold rush. The modern takeaway, the phantom income of landlording. Many young investors are tempted to buy a rental property instead of index funds. Bogle would ask you to calculate the real return. Being a landlord is a job. You have to fix toilets. You have to evict tenants. You have vacancy risk. If you earn 10% on a rental property but spend 10 hours a month managing it, that isn't passive income. That is a low-wage job. Capitura suggests a Bogle-led alternative. REITs, Real Estate Investment Trusts. A REIT index fund allows you to own thousands of commercial properties, malls, hospitals, data centers, without ever unclogging a toilet. It is liquid. It is low cost. If you want real estate exposure, buy the index. Do not buy a second job disguised as an asset. What about gold? In times of chaos, inflation, and war, investors flock to the yellow metal. Bogle's view on gold was scathing. He agreed with Warren Buffett. Gold is a non-productive asset. It has no earnings. It pays no dividends. It has no internal growth. If you buy an ounce of gold today, in 50 years, you will still have 1 ounce of gold. It will not have sprouted a smaller ounce of gold. If you buy a share of a company in 50 years, it will have produced products, paid dividends, and likely reinvested in new factories. Bogle called gold a speculation on fear. You are betting that someone else will be more scared in the future than you are today. He advised the intelligent investor to have zero allocation to gold or commodities. Pivot to the digital gold. This argument is the central battleground for Bitcoin. Proponents call Bitcoin digital gold and argue it is a store of value. The modern takeaway, the productivity razor. Apply Bogle's razor to your crypto portfolio. Does the asset produce cash flow? Some proof of stake coins do generate yield, which makes them more like bonds and gold. But pure store value tokens rely entirely on the greater fool theory. You need a buyer willing to pay more. Bogle would not forbid you from owning Bitcoin, but he would classify it strictly as gambling money, not retirement money. If you must hold it, cap it at 5% of your net worth. Never let the non-productive asset threaten the productive core of your wealth. One of the darkest fears of the modern investor is a Japan scenario. In 1989, the Japanese stock market, Nikkei, peaked. It was the envy of the world. Then it crashed. And it didn't just crash for a year, it stayed down. It took over 30 years, until 2024, for the Nikkei to finally reclaim its 1989 high. If you were a Japanese investor who went all in on your home country in 1989, you lost 3 decades of compounding. You retired poor. Critics of Bogle often ask, what if the S&P 500 becomes the next Nikkei? What if the U.S. economy stagnates for 30 years? Bogle was an optimist on America, but he acknowledged the risk. The solution: this is the strongest argument for global diversification, investing in the total world index. If the U.S. stagnates, it is likely that emerging markets, India, Brazil, etc., or other developed markets will pick up the slack. The modern takeaway: the rise of geopolitical hedging. In a multipolar world where U.S. hegemony is being challenged, holding 100% of your assets in U.S. dollars and U.S. stocks is a bold bet. The Boglehead solution is not to try to predict the winner, but to own the whole world index, VT. If the U.S. wins, you win because the U.S. is 60% of the index. If the U.S. fails and India rises, you win because India's portion of the index will grow. You are betting on human ingenuity, not on a specific flag. We have spent hours talking about how to grow the mountain of wealth. But climbing up the mountain is only half the journey. The most dangerous part of mountaineering and investing is the descent. This is a decumulation phase, retirement. Bogle pointed out a cruel irony. The skills required to get rich are the opposite of the skills required to stay rich. To get rich, you need to take risks, be aggressive, and save. To stay rich, you need to be conservative, spend, and manage cash flow. The standard advice for decades was the 4% rule. You can withdraw 4% of your portfolio in the first year of retirement and adjust for inflation every year, and you will likely not run out of money for 30 years. But Bogle had concerns. In a world of lower expected returns due to high valuations and longer life expectancies, people living to 95 or 100, the 4% rule might be too risky. The modern takeaway: the concept of dynamic spending. Instead of blindly spending 4% every year, the modern Boglehead uses a flexible rule. If the market crashes 20%, you tighten your belt and spend less that year, maybe 3%. If the market booms, you treat yourself maybe 5%. This flexibility acts as a shock absorber. It prevents you from selling too many shares when the market is down, sequence of returns risk. Technology now helps us here. Apps like New Retirement or Projection Lab allow you to model these dynamic withdrawal strategies, ensuring you don't outlive your money. There's a modern philosophical movement led by Bill Perkins called Die with Zero. The argument is that saving money for a future you might not see is a waste of life energy. You should spend your money while you are healthy enough to enjoy it. If you die with $1 million in the bank, that is $1 million of experiences you didn't have. Bogle's view was different. He viewed himself as a steward. He lived modestly until the end. He didn't see unspent money as waste. He saw it as legacy, money that would go to charity, to his children, to the causes he believed in. How do we reconcile these views? It comes down to your personal definition of utility. The modern takeaway: consumption smoothing. The Boglehead philosophy doesn't forbid spending. In fact, knowing you have enough allows you to spend guilt-free. The tragedy of the modern saver is that they are so terrified of poverty that they live in poverty voluntarily. The Capitura balance is to use the safety margin. Calculate your survival number, what you need to pay bills. That money must be in safe index funds and bonds. Anything above that number is your joy fund. You can spend it, give it away, or invest it aggressively. Bogle gave us the math to know the difference between survival and surplus. We must address the mental toll of being an investor. Jack Bogle was a fan of the Stoics, Marcus Aurelius, Seneca. The core tenet of Stoicism is the dichotomy of control. You must distinguish between what you can control and what you cannot. You cannot control inflation, interest rates, the election, the Fed, or the daily price of Apple stock. You can control your savings rate, your asset allocation, your costs, and your reaction to the news. Most investors spend 99% of their energy worrying about the things they cannot control. They watch CNBC and worry about the federal. This is a recipe for anxiety and poor performance. Bogle urged us to focus 100% of our energy on the things we can control. The modern takeaway: financial mindfulness. In an attention economy designed to trigger your cortisol, stress hormone, the Boglehead portfolio is a mental health tool. By accepting that you cannot beat the market, you release the burden of trying. You don't have to be smarter than the crowd. You don't have to wake up at 4 a.m. to check Asian markets. You are free. The ultimate return on the Bogle strategy is not just money, it is peace of mind. Simon Sinek talks about the infinite game. In a finite game like football, there's a clock, a score, and a winner. In an infinite game like business or life, the goal is not to win, but to keep playing. Investing is an infinite game. There is no finish line. Even when you retire, you are still investing. Even when you die, your trust or your heirs are investing. Wall Street treats it like a finite game. Did you beat the S&P 500 this quarter? Bogle treated it like an infinite game. Did my family survive and thrive over 50 years? When you switch your mindset to the infinite game, short-term volatility becomes irrelevant. A 20% drop in 2022 is just a blip in a 50-year chart. The modern takeaway: generational time frames. We are seeing a return to multi-generational thinking. In a world where Social Security is uncertain and pensions are gone, the family bank concept is rising. You are the founder of your family's financial dynasty. By adopting the Bogle strategy, you are planting trees under whose shade you never expect to sit. This perspective shift makes it easier to hold through the crash. You aren't holding for your vacation next year. You are holding for your granddaughter's college fund in 2045. Imagine writing a letter to yourself 20 years from now. What would that version of you say to the version of you today? Would they thank you for checking the price of Bitcoin every 10 minutes? Would they thank you for panic selling during the election? No. They would thank you for being boring. They would thank you for setting up the auto transfer and forgetting the password. They would thank you for ignoring the hot stock tip from your brother-in-law. Jack Bogle's life was that letter to the future. He was the man who saw over the horizon. He saw that the croupiers of Wall Street would eventually be exposed. He saw that the mathematics of value would eventually triumph over the psychology of speculation. We have now handed you the keys. The doors to the fortress are open. Buy the haystack, index funds. Fire the croupier, low fees. Stay the course discipline. Know your enough contentment. This is not a get-rich-quick scheme. It is a get-rich-sure path. It requires the courage to be different by being simple. In a world of noise, silence is the ultimate edge. Thank you for taking this deep journey with us through the life and logic of John Bogle. You are now part of the minority of investors who understand how the machine actually works. If you are ready to take the next step to explore the psychology of money even deeper, make sure you're subscribed to Capitura. Our next series will dissect the behavioral biases that trick our brains into losing money and how to rewire your mind for wealth. The market is open. Your future is waiting. Stay the course.